Good evening, all. Ira Epstein of Linn & Associates with your SPDR ETF wrap-up, and this is for Wednesday, and we're at the 6th of May, 2020, and the time about 5:50 p.m. Central Time. So we had a down day in a number of the markets behind me, as you can see. Quite a few of them were down. QQQ went for a new high on the year. The futures did not, so you've got a divergence. You've got the ETF that follows it, make it a higher high for April. Not for the year, if I said that, I'm sorry. Went over April's high, you didn't do it at all in the futures market. So we'll see what goes on there. Metal's still under some selling pressure today. TLT saw a big hit to the downside, and the market went down to a key support area as well. And that's because we saw that the government is going to sell nearly $100 billion in Treasury certificates this coming week. And they introduced even a new 20-year. In fact, we had it before, a 20-year bond. Now it's coming back. So all the things you got to be looking at. Mixed bag in the currency sector. So let's go to the charts. What are the two strong sectors? Technology, QQQ, right? So we know the index, we know the sector. We know the FANG stocks are on fire. No question about that. We know the ones that, like the restaurants, they're under trouble. We know Lyft, I was surprised today, did better, but the ridership's way down. So it's how you want to play with the numbers, and will people go back in these things? How do they feel about shared rides going forward? I mean, there's a whole world that's changing right in front of you, and I can't answer how it's going to look. What I can answer in all these is the markets come off these March lows as though nothing is wrong. I feel that's terrible. I do realize there's a new world out there in technology. I get that. If you think your restaurants around you are all coming back to business, let's give it 6 months and you tell me how many for rent signs are hanging out there. It's going to be massive. Bars, I don't know. Chicago's a convention hub, right? None for the whole summer. What about all of our Lollapalooza for the kids and all the big concerts? All canceled. The governor today doesn't think we'll open restaurants until June 26th. Not May, another month. How do they make it? This is just part of it. I mean, it just goes on and on. So I get it. I get that if you're at home, you're using technology. I know your bandwidth is going up. I know what you're doing. And I know people are going to go back into offices now, but they're going to look different. Plexiglass makers, they're probably going to have a field day setting up differences there. Okay, things you watch. When we come to the tech sector, and that's why I watch the tech sector, it's the one that I hone on because I think it's the strongest sector there is. So this is the one I build charts on. You've been with the higher lows, higher highs. The trend is up. No argument there. The market's over the 18-day moving average of closes, which is over the 200-day, and it may even cross over the 100. That would be another very bullish event. Moving average crossovers, traders look at them. You may not agree with them. It's unimportant what you or I think. We have to understand what traders look at or algorithms look at. You know, today it's a lot of algo trading, but you know, if you think about an algo, it's no more than the sum of all knowledge you're putting into computer code. It can do it quicker. It thinks faster than we do. When you take a look at putting this all together, though, you're in an uptrend. You've got upside bias. There's no overhead on a moving average resistance. Where the resistance is right here. You're at that upper Bollinger Band. The odds of closing over and staying over this Bollinger Band are 95% of the time you will not. 5% of the time you can. You can do one of these where you get under it, you get back over it. Nobody's saying you can't. And nobody's saying it can't happen right here. All I'm saying is you're at a resistance point in the market on an uptrend going into an unemployment report on Friday. I don't know what the reaction to that report's going to be, so I wouldn't be surprised if some money's coming off the table here. When I look at momentum, it's simply overbought. It's not like it was back here where the slow stochastic was going sideways over 80, locked in, what we call embedded. This is just overbought. It's the beginning process. Absolutely. And to start the process, you have to first get overbought. I am not bearish. I am just saying I think the bulls are looking to take some money off the table. SMH, well, it's not too far away. It's the 25 index of big semiconductor companies. Okay, I get that. And the pattern is a lower low and a higher high. It's not a trend. The market has come up again to the 100-day average of closes, having some resistance. And each time it's fallen in the past 3 days to the 18 or the 200, it's found support. It's looking for direction. And in the process, it's starting to go very much sideways here. Momentum had been pointing down, and now it's flattening itself out. When we come to the industrial sector, the market could easily tomorrow enter bear territory. Any move under 60.60 will confirm lower high, lower low, putting into play the possibility of getting back to 59.06. The problem for the market is it's already oversold. Any reading under 30 is an oversold reading. In the energy sector, you keep bumping up to the upper Bollinger Band. 95% of the time you'll stay confined, but it's pushing the Bollinger Band higher, and you should recognize that. There's divergence. Where's the divergence on the chart? Momentum's pointing down as price is trying to work itself higher. It only got overbought, and it's working down from there. I again think the smart money has been, if they're buying, they're taking money off at that resistance point. QQQ, as I said, this market went up and took out the April high. But when people say sell may go away, they're not talking about QQQ, SPY, DIA. They're talking NASDAQ. They are talking S&P, the Dow, and the Russell. That's what they're talking. These other ETFs that follow them, there's a bit of divergence in them and how they're set up and what they do, how they roll the futures and so on. But in any case, overbought, haven't quite hit that number. The resistance, as I see it, 221.75, support back to 213, certainly an uptrend, certainly an overbought condition. When you come to the emerging market, you had one shot, or the traders did, they had one shot to get out when it hit the upper Bollinger Band. You had been in an uptrend. That was where I think they took money off the table. And the regrouping point is that line in the sand. The 18-day average is the DMZ zone between North and South Korea. It's where a market often hunkers in, trying to figure out what next. But there's more on this chart. This chart's going very much sideways in those bands. So again, we're getting what we had way up here when the market was going sideways, and from that sideways action is where events happen. We'll find out if it's up or down. In GLD, you are looking at momentum down. You are looking at a trend that's been down, lower highs, lower lows. It got through an important number. Yesterday, what the market tried to do, and this is yesterday, you had set up right at the end of the day, higher lows. This high took out the day before. So the market effectively became bullish. An outside day is a trigger. If you take out, this is my own rule, so take it for what it's worth, throw it away. If you take out the low of an outside day within 2 trading sessions, for those of you that use 5-minute, 20-minute, the concept to me is the same on the chart. If you take it out, it's a trap. And in that trap, the market looks to go to an area. I look for the closest moving average, the closest major moving average. You can decide what you think those are, or a Bollinger Band. Today, what the market did is took that out. So that didn't work. You're back into a downtrend. When I look at the gold miners, are you going to embed here? So you need 3 days in a row of over 80 to embed. Both numbers over 80. Yesterday, both numbers over 80. And if we go one more day, there. So you're embedded, which is bullish. Traders will support that market until that red line drops under 80. Now, unlike the futures, this will look at the miners, so I can't tell you that the futures drop in gold will drop that. Right now, it's friendly. Don't deny that it's not friendly. Lose the red line under 80, then I think you're going back to the 241. More important to me is what happened. You had a shot here for the pros to come out, and I bet they did. That's just my guess. Against that upper Bollinger Band. I think they came out there. They might have bought again as the market popped through this, but now I think they're pretty close to neutral. Tell me on TLT. Coming in, you've got a downtrend. Oversold as can be. If the market breaks, I'm looking for the lower Bollinger Band. If you get back to the 18-day average, which is 168.02, you negate the downtrend because then you'd have a higher high, lower low. The market lets go, goes right to that Bollinger Band number. You know what I'm going to tell you? I think the smart money came out today. FXE, no trend at all. Some people went into that German situation where Germany's high court was going to rule if the EU via the ECB, if all that they did was legal under German terms in order to German law. Well, it isn't, according to the German high court. I don't know how it gets resolved. We'll find out. But a lower low and a higher high. Put it together, that's where you're at. Now, a lot of traders ask me some of the tools that I use, and there's an array of them that I use. One that I've been using for years is this one from the Moore Research Center. And if you don't know what seasonals are, you should learn. And I don't care that you're an ETF or a spider trader. The underlying factors in many of them are what the futures are doing. And they show you this by looking at this. They'll look at seasonal trades. And their criteria on seasonal trades for them to list it. The trade has to work a minimum of 13 out of the past 15 years. If it drops to working 12 out of 15, it's dropped. Past performance has strict limitations. It is that. It's past performance. You can get 15 years out of 15 years, and I've done this. I go, this won't lose. I'm like Swiss cheese with those that don't lose, all right? But tie it together with your other chart work. Now you're getting an array of tools that make some sense. They write articles, they'll talk about spreads, they'll give you ideas. You can go on their website and you can work with their charts, and it plots right over the chart action that you've got. You're getting an idea as to where these markets work. It's worth looking at. If you haven't seen it, go to our website, sign up for a free offer of it. We'll take care of the rest for you. You can always call my staff. They'll get it for you as well. In the meantime, I'm Ira Epstein. Thanks for watching, and I will see you all tomorrow.